All right, let's just dive right into this explainer. Today, we're putting Wise Markets through the absolute ultimate analytical gauntlet. Because as an investment analyst, you know it's not enough to just glance at a company's latest earnings report. We really need to break it down. So we're taking all our data on Wise Markets, ticker symbol WMK, and we're stress testing it using the proven frameworks of investing legends Warren Buffett, Peter Lynch, and Benjamin Graham, before finally running our own discounted cash flow model. By the end of this, we're going to know exactly what this stock is truly worth. Here is our roadmap for the breakdown. We'll snap a quick company snapshot, look through the lenses of Buffett, Lynch, and Graham, crunch the DCF and other models, and then bring it all together for our synthesis and final verdict. Section 1. Company Snapshot. Let's get a feel for what this business actually does and how it's performing right now. So Weis Markets is a regional grocery stalwart that's actually been around for over a century. They operate 201 stores spread across Pennsylvania and 6 neighboring states. But here's the cool part. They don't just generate cash from traditional groceries. They also run pharmacies, fuel stations, and impressively, their very own manufacturing facilities that churn out milk, ice cream, and fresh meats. Let's look at the baseline numbers from their latest filings. The stock is currently trading around $78.05. Q1 2026 was solid, pulling in $1.26 billion in revenue, which is a 4.6% bump year over year. Their trailing 12-month earnings per share sits at $4.12, and they reward shareholders with a rock-steady $1.36 annualized dividend. All in all, it's a picture of very steady, if slightly unspectacular, top-line growth. Moving to Section 2, the Warren Buffett lens. Now, when the Oracle of Omaha looks at a stock, he ignores the market noise. He is laser-focused on business quality, economic moats, and pristine balance sheets. Through Buffett's eyes, Weis is a fascinating mix. The economic moat is, frankly, pretty narrow, since the grocery sector is hyper-competitive. But they self-distribute 51% of their products, which is a massive logistical edge. And management? Incredibly prudent. Get this, 0 major long-term debt in their Q1 2026 report. They paid a microscopic $13,000 in interest expense. With $1.37 billion in equity against just $656 million in total liabilities, it is quite literally a fortress balance sheet. The catch? Return on equity is hovering around 7.3%, which definitely misses Buffett's usual 15% benchmark. Plus, while earnings are mostly consistent, they did take a noticeable dip back in 2023 before rebounding. So the big question here is, how much cash does this business actually spit out for its owners? And what kind of price would Buffett demand to get his famous margin of safety? Because he wants a great business, sure, but only at a fair price. Well, their recent trailing 12-month free cash flow was dragged down to about $24 million because of some heavy spending on new stores and upgrades. To be fair to them, we need to normalize that free cash flow to around $50 million going forward. If we take that normalized cash, apply a zero-growth perpetuity model, and demand a strict 50% margin of safety, which Buffett totally would for a slow grower, his absolute maximum buy price lands right at $39 a share. At $78 today, Buffett is definitely staying on the sidelines. Section 3. The Peter Lynch Lens. Let's shift gears and use Lynch's methodology, famously known as finding growth at a reasonable price. Lynch would instantly tag Weis Markets as a stalwart. You know, a large, mature company with reliable but slow earnings growth that pays a decent dividend. Lynch actually loved having stalwarts in his portfolio for protection, but his golden rule was valuing them using the PEG ratio. That's the price-to-earnings ratio divided by the earnings growth rate. So let's run his metrics. The balance sheet is beautiful, $97 million in cash and $101 million in marketable securities. And we'll just assume neutral insider and institutional ownership here to fill a slight gap in our source data. But here's the glaring problem. The current PE is 19.63. Their earnings growth is just about 5.1%. When you divide those, your PEG ratio shoots up to 3.8. Lynch wants that number under 1.0. You're simply paying way too high a multiple for 5% growth. So for Peter Lynch, this is a hold or even a sell. He'd love the stalwart nature and the fortress balance sheet, but at $78, it's just overvalued. He'd need the price to drop well under $40 to even get a reasonable PEG ratio. Section 4. The Benjamin Graham Lens. Next up, the father of value investing himself. Graham doesn't care about flashy growth stories. He cares about downside protection and buying dollar bills for 50 cents. If we run Weis through Graham's strict defensive investor checklist, it actually performs amazingly well. It easily passes the size requirement with $1.26 billion in just one quarter's revenue. The financial condition is phenomenal. Current assets of $674 million completely dwarf the $330 million in current liabilities. Steady earnings, steady dividend, and a price-to-book ratio of 1.4, safely under his 1.5 limit. It passes 5 out of 6 tests. The only fail is, again, that slightly hot PE multiple at 19.63. To figure out exactly what Graham would pay, we use his legendary intrinsic value formula, which blends earnings and book value to find a mathematically safe valuation. So let's plug in the EPS of $4.12 and the book value per share of $55.39. The math gives us a hard intrinsic value of $71.65. Now, this is fascinating. At the current trading price of $78.05, there is absolutely zero margin of safety according to Graham's formula. Graham would likely demand a steep discount to this intrinsic value, meaning he'd patiently wait for a market panic to push the stock down below $50 before buying. Section 5, DCF and other valuation models. All right, let's step into the modern era of quantitative finance. We've done the classic gurus. Now let's run a discounted cash flow and some comparable models based strictly on the raw data. A DCF model relies heavily on our assumptions. Like we talked about earlier, recent CapEx artificially pushed trailing free cash flow down to $24 million. To give the model a fair baseline, we're transparently assuming a normalized free cash flow of $50 million. We'll lock in a very conservative 2% steady-state growth to match grocery industry norms and a weighted average cost of capital of 8%, which perfectly reflects their zero debt equity risk. Running this through a sensitivity table is where things get real. Check out this matrix. Even if we're super generous and give them 3% terminal growth with a low 7% discount rate, the absolute highest fair value this DCF spits out is $52 a share. Our base case and an 8% discount rate yields just $35.40. Cash flow valuation is just brutally punishing to capital-intensive, slow-growth businesses. And when we apply a couple of other quant models, the story stays the same. Valuing the company using its own 5-year historical average PE of 17.39 gives us a value of $71.64, which is almost perfectly aligned with the Graham formula. On the flip side, a strict dividend discount model brutally punishes their low dividend yield, dragging the value all the way down to just $19.61. Section 6, Synthesis and Final Verdict. We have run the gauntlet. We've seen it through the eyes of Buffett, Lynch, and Graham, and we've crunched the DCF. Now it's time to blend it all into one final recommendation. When we lay out all our targets, every single model, whether it's based on cash flow, book value, or historical multiples, screams that the fair value is sitting well below the current $78 trading price. The absolute highest valuations we could justify were in the low 70s. To actually secure a true margin of safety, all of our investing legends would be waiting for an entry point somewhere in the $30 to $50 range. Visually, the takeaway is pretty stark. The current price completely towers over both the Graham intrinsic value and the cash flow-based DCF value. Yes, Weis Markets boast an incredibly strong debt-free balance sheet. Yes, they have steady revenues and dividends. But right now, the market is asking you to pay a massive premium for that safety. So ultimately, our final verdict for Weis Markets is a definitive hold. If you already own it, it's a phenomenally stable business. Sleep well at night collecting that steady dividend, knowing the balance sheet is basically bulletproof. But for new money, you are simply overpaying for slow growth. Value investors should absolutely wait for a pullback into the $50 to $60 range before jumping in. Which really leaves us with one final provocative question for your own portfolio. In today's unpredictable market, just how much of a premium are you truly willing to pay for absolute financial stability?